Welcome to the Move Logistics 2022 full year results call. I will now hand over to Mr. Chris Dunphy.
Thanks very much, and thank you everybody for joining this call. Joining me today is Lee Banks, our CFO, and Chris Canoose, our Chief Operating Officer for Move Freight. James Waters sends his apologies. He's actually doing some client calls today, so he'll be dialing in remotely. So without any further ado, Lee's going to be on the slide turning, and we'll kick it off in terms of discussing how we went for full year 2022. I guess the key takeaway is that we came in at or just slightly above where we said we would in terms of guidance with respect to income, EBITDA and EBIT. The NPAT number is of course normalised. We've got some non-trading adjustments in there, about 3.4 mil. Obviously, we took the opportunity to do quite a lot of restructuring during the year, and that's reflective in those numbers. Very pleasing to see our stats around safety trending in the right direction, 15.81 versus 19.84 in terms of our LTIFR. Our gearing is a lot better than it was when I was talking to people about this time last year. Obviously, post our $40 million cap raise, and our free cash is strong. Yes, it could be stronger, but we're obviously dealing with a number of customers who are having issues around COVID and chasing them along for payment. No great issues or concerns there with respect to bad debts, but certainly we are seeing some delinquency with respect to payment. Thanks, Lee. Next slide. In terms of our strategic priorities, I know it sounds, for those of you who've heard me speak before, like a repeat, but we're very much on a 2-year journey with respect to what we're doing with Move Logistics, particularly in terms of the freight division. That's been the laggard operation, and we're now very much into that business with respect to how we fix it, how we improve the service we're giving to our customers, making sure that the customers are paying us the right rates, and getting ourselves match fit for the future with respect to new investments in things like IT, our transport management systems, etc. What we've done in the last 12 months, obviously our business review is done. We've got very strong chief operating officers in Chris and James in our freight and contract logistics business respectively. We've got a great management team, a full bench with respect to people who have joined the Move movement, and obviously we've got some new board members, Mark Newman, formerly of Mainfreight Europe, Grant Devonport, formerly CFO of Toll, on board with us as non-exec directors. Gives us a really great knowledge in terms of our space, and certainly helps me a lot with respect to what we're talking about in terms of implementing a strategy going forward. Very appreciative of the support we got in our $40 million cap raise last year. We've now got a share registry which has a number of very progressive institutional investors who understand our story and are prepared to invest alongside us for the ride ahead. So really great to have the number of Australian instos as well as the Kiwi instos who've come into Move and on our registry. Obviously, we also did an ASX compliance listing, so that helps us. And as we signalled when we did our capital raise, our intentions are very much to be an Australasian business. The other things that are in progress, well, we've had some really great support from Waka Kotahi in respect of the grant that we've been given for coastal shipping. That's $10 million. That's singularly the largest amount that Waka Kotahi gave to any one proponent. There were 3 other successful grantees alongside of Move for a total of 30 million, of which Move got 10 million. So we're very privileged and appreciative of that support. In terms of our ocean strategy, which is completely separate from the Waka Kotahi money, we are very much in the execution phase. We've obviously announced that we've acquired our first ship, the Atlas Wind, and that's been very strongly underpinned by Trans-Tasman customers who want a service between secondary ports in Australia and some under-serviced ports in New Zealand. So, we're very excited about what that means and what it does for other parts of our group. We've got some very strong positions now in terms of industries that we are already in, and we need to be able to demonstrate a lot more skill and aptitude for. And without going into an exception, we are already strong in aquaculture. We want to get stronger in it. We're already strong in viticulture. We need to get stronger in it. We're already strong in our approach to fast-moving consumer goods customers. We have a great opportunity within our contract logistics business to further strengthen that offering. And obviously, we've got skill sets in terms of people which back that up. The other things that are in progress, we are very much a large consumer of industrial property. We need to obviously be very mindful of things like vacancy rates and space, but also being in a position where we only make commitments going forward when we've got customer commitments on the other side to back it up. Very big part of our focus is holding on to good people. We're in an environment at the moment where the ability to up sticks and move overseas is very strong. The borders are all open again, and one of the things that we are very focused on is making sure that we are holding on to our team members, and certainly in terms of remuneration, we are aware of the issues around inflation and the fact that we need to ensure that our team members are being properly and adequately remunerated. The other thing that's in progress is obviously a sale process to our specialised business. This is a very good activity which has been obviously impacted by COVID in terms of infrastructure and commercial property projects that have been deferred. We've had several unsolicited approaches which led us to run a sales process for that business, and we've been quite pleased by the interest that's been shown in those assets and activities. So that's an ongoing process. We have nothing to report today definitively in respect of that sale, but it is an ongoing point of discussion. Thanks, Lee. Next slide. Again, just in terms of FY22, we're all dealing with what happened with COVID. It had a significant impact, as we indicated at our half year and in our trading update, particularly in terms of our fuel business and the fuel deliveries, which was obviously, we delivered less litres, which meant that our fuel business didn't get the returns that it would otherwise have. We've seen massive disruption in FY22 in the supply chain. Unfortunately, we didn't have the size of international air and ocean that some other companies do that benefited significantly from that disruption. Our impact was significantly more muted, but what we were able to do was continue to provide pretty good levels of service to our customers. Not as good as I think Chris Canoose and James Waters and I would like, but obviously dealing with absenteeism and all of the issues that COVID threw up, we've come through it pretty well, and we're really appreciative of the team that we've got in terms of getting the result that we did. It was hard yards when you've got all of those impacts and imposts around where you can go, where you can't go, what customers have COVID mandates, what don't, and juggling all of those effects was quite a significant aspect of our FY22 year. Fortunately, it's not something that we see or envisage is going to be there in FY23. like a lot of other businesses, learning to live with COVID. And I think that the results that we're seeing already for this year that we're entering into, we can all take some degree of measure that we might have seen the worst behind us. However, inflationary pressure is everywhere. The consumer has had to deal with that. As a business, we've been dealing with it in terms of our costs, not just fuel, and we obviously pass on fuel adjustments to our customers, but we've had some significant delays with respect to our orders for new equipment. They have a number of impacts on us, not the least of which is that our R&M bill has been a lot higher than we would have liked because of the fact that we've had to keep older trucks going for longer than we would otherwise in terms of prudent fleet management. It also means that our approach to becoming more asset light and getting owner-drivers into the business has been challenged because obviously in terms of migration and equipment, we haven't been able to get either the intending owner-drivers or the gear that they would otherwise be buying into our fleet. So that's a snapshot on the operating environment. Obviously happy to take questions later if anybody wants to talk more about that. I'll hand over to Lee now in terms of the financial results. That slide in terms of the move picture and livery was taken at Cromwell in Central Otago. Our new colour scheme is now very visible to the market, and it's very heartening in terms of the feedback that we're getting on it. So over to you, Lee.
Thank you, Chris, and welcome everyone to our results call. As Chris has said, we have made good progress on the company reset despite the operating pressures and the impact of COVID that it had on many of our customers' normal trading levels. We incurred $3.4 million of costs related to the reset, which have been excluded, and therefore we are presenting normalised numbers. Our financial results are reported on a continuing operations basis also. These exclude the specialist division due to the planned divestment of this business. Our prior year profit and loss has also been restated. Revenue was up $16.8 million on the prior year as we benefited from the ability to pass through rising costs. Normalised EBITDA of $54.3 million was in line with our guidance of $53 to $56 million provided in May this year. Our normalised profit for continuing operations before non-controlling interests was $400,000, an increase of $600,000 from the loss in the prior year. Including discontinued operations and the reset program costs, Move reported a net loss after tax of $4.2 million. The focus on margin improvement continues to be a priority as the company looks to generate long-term sustainable earnings growth. Our normalised EBITDA, while flat year on year, was impacted by contract logistics being down. This is due to both the impact of COVID during lockdown periods on fuel deliveries, and the prior year result did include some one-off positive benefits from contract settlements. Freight has shown improvement, and international has had a strong year-on-year performance, consistent with positive market conditions. As Chris mentioned, fleet maintenance costs remain high due to the delay in our asset replacement program as a result of the extended lead times for delivery of new fleets. Corporate costs have been reduced as a result of the reset program, and we are moving forward with a leaner structure across the group. We expect a stronger performance in FY23. Improvements in freight are starting to land. Contract logistics has been reset and is poised for growth. And international is maximising the opportunities in the market, including through our new Trans-Tasman shipping strategy. Free cash flow has remained solid at $43.9 million, despite the impact of the one-off restructuring costs. The working capital increase is mainly due to delays, as Chris mentioned, in some of our customer payments. However, 2.2 was paid in early July. We also planned a reduction in our creditor days, which did affect working capital. The increase was, however, offset by net capital expenditure, which was down on prior year due to the delays previously mentioned. Cash conversion is a key focus for us, and our aim is to improve it back above 90% in FY23. Move's balance sheet has been strengthened over the last year with a significant reduction in debt following the successful capital raise in November last year. Net debt at year end was 20.8 million, a year-on-year decrease of 43.5 million, and as a result, gearing has improved. At the start of the FY22 year, we refinanced our bank debt with improved terms and longer tenure. This was further streamlined post the capital raise, and in March, borrowings were consolidated to one funding partner, the ANZ. Our working capital ratio remains strong at 1.53. Net capital expenditure was down year on year. Continuing global supply chain disruptions have led to a delay in Move's asset replacement program, with lead time for delivery of new trucks significantly extended. And due to the age of many of our fleets, we have had a significant replacement program planned over the next 2 years, with the new assets we were expecting in FY22 now delayed until FY23. We are also investing in technology and expect this to increase in FY23 as our digital transformation gains momentum. Thank you, and I'll just pass you back to Chris, and he's going to talk to our divisional performances.
Thanks, Lee. Well, obviously we've got a much cleaner, tidier business, as Lee's indicated, than where we were in July of last year, notwithstanding all of the COVID conditions that everybody has experienced. I'd just like to start, obviously, with sustainability. We are, a business that moves and consumes a lot of carbon and a lot of kilometres. We don't have any other reason to do it than because our customers need the goods that we are transporting moved. And in that regard, it's very heartening to see graphs and trends like we've got with respect to our key safety indicators. We are a business that relies entirely upon a committed workforce, and their safety and the safety of other users in terms of the environment we operate in is paramount. So great to see those trend lines. The other things that we've done around sustainability, per the slide, we've been recertified with respect to Toilu Carbon. We've got a very clear focus to decarbonise. It's a real mantra in the business. We are looking forward to getting our hydrogen fuel trucks like the other equipment that we've ordered last year. These have been delayed, but we are still expecting them in this year. We're obviously really pushing hard on the multimodal piece, and that's just all about removing trucks. If you think back to what the precursor to Move was, TIL, it was a trucking company. Move is a multimodal freight company, freight and logistics, and that's the thing that we will keep talking about for some years to come. We've obviously, in terms of our sustainability, made a big push, and the other aspects of our business which are moving ahead is our digital transformation. Anthony Barrett joined us as our CIO in the early part of this calendar year, and he's doing a really great job with respect to how we are making the digital transformation work in our business in terms of our expectations around what a transport management system can do, not only for efficiency within the business, but also for our customers in terms of how they get an experience with us. So, we've got a number of initiatives underway there, but the big one is the TMS and freight, and of course the consequent effects of that in terms of other parts of our business and how they become more and more paperless, but also how we are getting information digested and returned to our customers faster. Thanks, Lee. In terms of freight, I'll hand over to Chris Canoose to talk about the freight division. Chris, do you want to say a few words?
Yeah, thanks, Chris. Look, as Chris has said before, we're well on the way to our journey. Big focus for us certainly is our people, as we look to retain, stabilise, and become an employer of the future. We haven't waited to be left with a shortage. We're very proactive in about keeping our people, forecasting that, what we need to pay them now, and go to the market to recover that. Our LCL division, we've worked hard to get a fixed line haul network as opposed to the old way of we had ad hoc floating fleets running up and down the country. We know in an LCL market you can't do that. We've worked hard in that area, and we're 95% complete of having that network set up. We've also been working hard towards our not only maintaining our current FTL fleet, which is our full truckloading division, but also bring on owner drivers in that space as well. Certainly is, you get a lot of bulk movements of freight comes in the likes of the steel, ammonium, porter comms, that sort of stuff that requires specialised equipment and specialised drivers. We're also looking at new facilities from old facilities, but we're looking at Hamilton, Napier, Wanganui. From the old business, we've inherited old facilities that certainly aren't suitable to where we need to go and what we need to be. So we're going to have in that space as well as rural areas outside of the main centres. And Northland's a focus for us as well, which we currently use agents.
Thanks, Chris. In terms of just, I guess, completing the picture with freight, we've got ourselves a business where obviously, we now have a very clear understanding of what our customer base looks like. We also have an even more frank and engaging relationship with our customers around what our expectations are in terms of margin and what we need to do in terms of recovering cost. So the business, in terms of its EBITDA, we're pretty happy with where we got to in terms of FY22, but the excitement really is about where we're going in FY23 and beyond. Thanks, Lee. Next slide. In terms of contract logistics, obviously you can see it was a pretty flat period with respect to our revenue and EBITDA. As Lee mentioned, the fuel deliveries, and we've obviously indicated this in the earlier announcements to the market. That had a big impact with respect to how our revenues in the contract logistics business fared during COVID. What we've got with respect to taking the business forward and how we sweat the assets in this business harder, it really is around making sure that we've got the facilities that we are leased and committed to full, and that they stay very much with high levels of utilisation. Obviously, we're going to our customers in this inflationary environment and engaging the inflation review mechanisms as well. So contract logistics has done pretty well in 22, and again, we'll talk a little bit about Fluidx and acquisitions, but we're pretty excited about what lies ahead for it in terms of 2023. International, again, the news feed for companies that have had international exposure has been nothing short of stellar. The shipping lines have have done the importer and exporter of New Zealand no favours with respect to their pricing methodology. What that has meant, of course, is that any company that is involved in that import-export supply chain has seen higher revenues and higher margins where you're taking a percentage of the revenue as a fee. And so our freight forwarding has been a beneficiary of that. The main issue for us, of course, going forward is that we're obviously wanting to grow our oceans division within international freight forwarding, and that's very much a case of what we're doing with the first Trans-Tasman vessel and, of course, the engagement that creates for us with respect to other opportunities around importing and exporting. So big part of the focus for 22 was getting our ocean strategy implemented, and 23 is about now with having the capacity and more opportunities opening up, what we can do in terms of being a Trans-Tasman shipping provider. This also, of course, feeds into our multimodal strategy, which again is part of our decarbonisation mantra. On to strategy. No, that's not a picture of me on the left, fortunately. Laying the foundations. Well, I think this goes without saying. We've had a very busy 12 months. I mean, I was stuck in New Zealand from July last year to November in terms of not being able to get back to Melbourne. And it's fair to say that we didn't waste any time in that 4 months making a whole lot of things happen. We obviously got a lot of work done, and it's really pleasing when I look at back on that 12 months what was achieved. But again, it's even more exciting in terms of how we now, with those foundations laid, how we now take this business forward. On to the next slide. How are we going to achieve our ambitions? Well, again, a lot of people will have heard me say this, so at the risk of repeating myself, we've got to work our assets smarter. We've got to be multimodal. We don't have the benefit of other companies' access to rail. We don't have the properties on rail serviced sites. So our multimodal offer will be very much about using the Blue Highway, very much about coastal shipping, and a smarter transport fleet, more fuel efficient, and more use of other fuel modes than diesel. Obviously, all of that has to pay its way, and as a shareholder, I'm working hard to make sure that we're getting our earnings optimised. Our growth will be a combination of organic and predominantly that's what we've been working on in terms of 22. In 23, we've got some exciting growth prospects ahead of us as a result of the work that was done last year. And obviously, what we've got as our mantra, moving as one, that's really very important too. So in terms of working the assets smarter, well, the biggest asset we've got is our people. But we've got to attract and retain good people. We want to be an employer of choice. We want to be a place where people who want to have a go at being owner-drivers or existing owner-drivers want to come and work. So, we have to be an attractive partner for our owner-drivers and our employees. We're doing that, obviously, through the freight reset. It's a whole lot of little things that make a great business, and it starts with making sure that the facilities that you've got people working in are at a very good standard, that you've got open communication, and that you've got leaders who are genuine and sincere and who actually talk the talk. So in terms of freight and contract logistics, we've got a lot of organic growth opportunity, and yes, we are certainly seeing some M&A prospects as well, which as they become more concrete, we'll be in a position to talk more about. Obviously, the IT aspect, you have a digital transformation, that just goes clunk to the bottom line once you've got those cogs meshing and working really well. And obviously, that is a very big focus of what the current year will be in terms of getting that TMS optimised and how it's going to improve our business. Thanks, Lee. Next slide. The multimodal offer. Well, obviously, as I've said, coastal shipping, Move Oceans, very exciting. Dale Slade, who heads that up, has been inundated with calls from not just existing customers but new customers. The Atlas Wind, our first ship, arrives in New Zealand in November. We have a couple of contracts of affreightment, which are basically effectively underwriting agreements as to cargo, which put that vessel in a very strong financial position. The board was, it didn't take too long for them to approve that CapEx because of the compelling economics around what's being proposed. So it's a very exciting time, again, alongside the Waka Kotahi grant, to be a vessel owner and operator as opposed to a charterer or a company that can only use one mode, as in road, which was the position we were in less than 12 months ago. So very exciting to be building that multimodal offer. Obviously, optimising our earnings is really about sweating assets, driving returns for our shareholders. Being a bit brave, these changes that we've made in the business aren't revolutionary, but they do require action. They do require us to think less about how many trucks we've got and more about how we move the tons that are available. So our focus is less upon being one of the biggest truck owners in the country and more upon how we get the margins, the right margins, to pay the people that work for us and with us the right money, and to get a return to our shareholders. In terms of delivering for our customers, we've really decided that there are some verticals around viticulture, aquaculture, dairy, and beverages. By beverages, there's a nice picture of some Corona being delivered there, but it's as much about fast-moving consumer goods, and these are activities that we do already, but they're activities that we can do a lot better. So there will be a lot more focus in 23 in terms of how we deliver for our customers. In terms of making our business bigger, we've got a great opportunity to grow within the New Zealand landscape, as well as obviously the opportunities that exist via creating a beachhead in Australia. We are already a trans-Tasman business in a very modest way. A number of our customers that we have in Move in New Zealand are companies where the freight decision is made in Australia. So there's a lot of opportunity for us to leverage off that. There's a lot of opportunity for us to use our ASX listing and the capital markets that avails us to be able to do more with our shares in terms of growth, not just in New Zealand, but in Australia as well. So upsizing the business is really about doing smart transactions that give us a bigger footprint. As I've said earlier, safety is part of our mantra, but the things that matter in terms of our people and our team is all encapsulated in one phrase: we move as one. And if anybody would like to understand more about that, you've only got to have a look on the back of our trucks. There's a lot of really interesting words, but also some catchy slogans. We're not trying to be too theoretical or moralistic. We're trying to have a bit of fun with our customers. So we're trying to take care of the driving public as well as our team. That's what we mean by we move as one. So in terms of the outlook, obviously, as I've mentioned, we've made some great inroads to margin improvement in freight. One of the questions that's been answered online was with respect to the freight division, how it's tracking. It's tracking just fine. We are very pleased that the first uprate that we did has stuck. We've had some pretty tough conversations with a number of customers around what our expectations of an acceptable rate are, and that has gone pretty well. We've had very few customers elect to go elsewhere because they understand the journey that we're on, but also that we've made a commitment with respect to working with them to improve the level of service. So in terms of getting the margin improvement we need, we are fully cognizant of the fact that we run two businesses in the freight division, which Chris Canoes mentioned. We have an ability to service a full truckload market and service an LCL market, and those are both very important to us. So what we've got to do is ensure that in both cases we've got the right returns coming. That means having that TMS, transport management system, and people and equipment in the right places and in the right configuration. Obviously, the other part of improving our margin of freight is getting that R&M to a level that is acceptable and sustainable, and that's an ongoing process. But certainly, if we talk about green shoots, they are very much there. Contract logistics is really an exercise in asset utilization, and the outlook for that is also pretty good. We've made some very proactive steps towards reducing some capacity where we didn't have commensurate customer commitments. So the assets that we've got are being very well utilised, and we're making very sure that we're staying ahead of the inflationary curve with respect to where the customers are paying, what they're paying, and making sure that it's not just about CPI, but it's also about the activity that is attached to their work. Obviously, we know we're in an inflationary environment, and we've just got to stay ahead of that curve. We've got to make sure that wage price inflation is being dealt with by virtue of increases to our customers. So, we've got an 8% GRI going out to our customers next month. It's been well telegraphed, and it's simply in place to make sure that we can pass on increases to our team in terms of the costs that they are facing in terms of everyday life, mortgages, food bills, fuel, etc. So we know that's tough, but we also know it's necessary. Bolt-on acquisitions. I'll get to Fluidx in the next slide, but we are very much a business that has an eye to opportunity. We are not a company that can go out and make large transactions happen with lots of goodwill. We've got to create the goodwill ourselves with what we buy. So I'm really excited about the Fluidx deal, and very pleased to talk to you about that in the next slide. Shipping expansion. Well, we'll provide some guidance at our ASM in October. The expansion of our shipping strategy will be a key feature of that, and again, we're very, very excited about what the addition of not just the Atlas Wind, but the other vessels, be they chartered or spot, can deliver to us in terms of a bigger strategy around shipping. We have a mantra also of running this business on the smell of an oily rag. We want to recycle our capital, and that means in terms of if we do elect to dispose of the specialist business, that there are funds then available for us to use for acquisitions. So very much the approach that Move is taking with the shareholders' money is to be very judicious with it. We are very focused on the fact that the divisions have to make an acceptable return on funds employed. They need to be able to show very strong organic growth, but also if we're going to do deals, we need to be able to do it in a way that is very mindful of shareholder dilution and ensuring that whatever we touch has earnings accretion attached to it. Next slide, Lee. So, Fluidx. As announced this morning, Move has acquired Fluidx from Tony Galbraith, the vendor. Tony's been in this business for a lot of years. In terms of the New Zealand road transport industry, he's a bit of a luminary. Tony has agreed a transaction with us, which will see Move acquire the assets of Fluidx for a total price of just over 15 million, which includes a property. The business is a very enticing one for us. It fits very nicely into James Watter's remit under contract logistics, in that there is a number of customers that are very complementary to what Move is already doing in the bulk liquid space. Fluidx has a very high safety culture, very similar to what we are about and doing. But moreover, there's a great opportunity within the Fluidx acquisition to expand our customer offering, and that fits very nicely with the approach that we're taking to industries like the wine sector, like the dairy sector, and obviously where there's contracted, dedicated assets for a customer's very precious product. It's a good deal. We're paying 7 million up front. We're not paying any goodwill. We're buying the assets for what has been deemed and confirmed as market value. As we talked earlier, it's a situation where we've been waiting with significant delays for new gear. The Fluidx fleet is quite modern, and certainly part of its attraction to us, not the main attraction, but an adjunct, was that it gives us a whole lot of newer equipment which enables us to defray or defer capital expenditure that we would be doing otherwise within the business. So just a great bolt-on. I can't speak highly enough about how we feel this business will go within our group. Currently, we do fuel, dangerous goods and ISO tanks. With Fluidx, we expand into food grade, liquids, dry powders and tank cleaning. So it gives us a really nice fit, not just in terms of contract logistics, but also our freight offering, in terms of we can now go to customers where Fluidx is doing the bulk and provide them with a more integrated solution with respect to warehousing and freight. So a really great deal, and credit to our team in terms of the due diligence that brought it to the table. So very exciting. Settlement will happen in October, and we're looking forward to the Fluidx team becoming part of the Move team. So in terms of the chat, we're really now at the discussion point. Lee, Chris and I will be more than happy to take any questions. I guess we'll go with the ones that have been put forward on the slides. So in no particular order, I'll start with Kieran Carling, who's asked about the freight division and how it's tracking. We've obviously seen all of the commentaries around the economic conditions and weakness in terms of volumes. Obviously, what we've done in Move is to go through our customer base and through the process of aligning our rates to where our costs are. We're very conscious of the fact that there would be and there is scope for attrition. At the same time, we're also very conscious of the fact that the freight market and supply is quite dynamic. So we're in a process of responding to a number of RFPs in our not just with our existing customers, but also with organisations that don't use Move at the moment. And we are very much of a view that we will see our freight revenue continue to trend upwards with respect to how the market sees Move, but also how we fit in terms of market share in our full truckload, LCL, and coastal options. Another question that's been asked is with respect to labour shortage. Yes, there are pain points across the market with respect to labour shortages. We're very, very clear that, as I said, we need to be an employer of choice to retain people. We're working on a lot of initiatives, particularly in our tanker fleet, as to how we can retain and attract the best people. And we've obviously got a constant need for refresh and renewal. Our age profile with respect to drivers in that task is very much skewed towards older men, and we'd certainly like to get younger men and women into that business and offer training and solutions for them to be able to step up to take on those roles. Fuel delivery normalisation. Yes, we have seen the fuel deliveries normalise, but they're certainly not back to the levels that they were. We're very conscious of the fact that obviously the higher fuel price has curbed some consumer retail spending, and of course now that people can go overseas, we'd expect that the pinch point around the motoring holiday in New Zealand versus overseas travel could have an impact. It's not a material number at this stage, but we're certainly monitoring it very closely. The next question is in relation to the new prime movers. And Lee, I'm going to let you answer that one.
All right, yeah. So in terms of the pipeline of CapEx, it's definitely, the question is around, is it going to be accounted for as CapEx? So there are some leasing arrangements and there are some, yes, we are going to be buying. So it's actually a mixture. In terms of full year CapEx for FY23, just based on still trying to get clarity on the pipeline of fleet, we haven't got that number completely nailed, but we do expect it to be definitely higher than it has been in the last 2 years.
Thanks, Lee. In terms of the next question, which is in relation to international freight and the freight rates and whether they're sustainable, I guess there's two answers to this. Our international freight business would obviously like to see high freight rates continue because that improves their margin. I don't think that that does, the economy or the consumer any good. We've certainly seen a reduction in recent weeks in terms of the FAK rates, particularly inter-Asia and imports. So, I think that we're going to definitely see a reduction in sea freight rates in certainly the first quarter of next year, if not into the pre-peak season Christmas period of this year. What that does in terms of normalising the earnings for this division, well, of course, we group Move Oceans into our international division, and we're expecting to see significant increases and opportunities in activity because of Move Oceans. So from a normalised basis, we are not expecting any adverse consequences because of a pullback in international freight rates. Graham Finch has asked a question, are there plans to acquire properties adjacent to rail networks, or is the current focus entirely on the shipping network? Graham, if you have any information about where we could acquire rail adjacent properties, I'd love to hear from you. We are talking to Kiwi Rail pretty much every week about their rail property portfolio, and those discussions are ongoing. So the answer is yes, subject of course to price. We are very keen to become a rail freight forwarder and be multimodal using rail service properties. Chris, do you want to add anything to that?
Yeah, no, we're to your point, Chris. We're certainly talking to Kiwi Rail every day. In fact, we were down in Hamilton this morning looking at some property there. We've made it very clear, and they're very supportive of us being on rail served land to add to their capability. And there's a number of sites up and down the country that we're talking about.
Thanks, Chris. In terms of the next question as to when a dividend might be paid, the question has been asked, is there any chance of this happening in FY23? I would put the chance of that happening in FY23 as quite low. We don't have much in the way of imputation credits available, and certainly I would be certainly an advocate for being in a position to pay a dividend when we can pay our shareholders a fully imputed dividend. Fluidx acquisition, Commerce Commission. We are not expecting any issues there. We have made some discreet inquiries to Commerce Commission already. The bulk liquids market is a very open and contestable one. In the market segments that Fluidx operates in, as distinct from the fuels market that Move operates in, there are a number of competitors. Fluidx competes regularly against 4 other bulk liquids providers, and really Move is very much a fuel contract fuel haulier for 2 customers at the moment. So we don't see any concentration or market risk issues there. In terms of market share, again, it's all about how the market is defined, but Fluidx in terms of bulk liquids would be less than 10%. Move with respect to bulk fuels would be somewhere around 35 to 40%. What we have in terms of a crossover between Fluidx customers and Move customers now in terms of bulk liquids is close to 0. So we don't see that Move acquiring a company that has a 10% of a contestable market will run into any Commerce Commission issues. Greg Witham has asked, can you expand on desired Australian acquisition, please? Well, Greg, the answer is if you look at how we structured the Fluidx transaction, by buying a business with 11 million of revenue and paying no goodwill. That would be a pretty good structure for what we desire in Australia as well. We're looking to do deals that are smart for our shareholders and where the vendor recognises that we would be a good custodian of their assets. That's all the questions that have been asked with respect to the typed in Q&A. I'll hand over to the presenter as to whether there's been any other audio questions. Desi, can you confirm, please?
We do not have any audio questions right now. Allow me to reprompt once again, ladies and gentlemen. If you would like to ask a question, please press star 1 on your telephone keypad.
Thank you, Desi. Well, I guess while we wait to see if there are any audio Q&A, the team of Move really appreciates the interest shown by the investment community in our business. Obviously, the takeaways are that we met guidance for 22. We had we took the opportunity to take some reasonably significant restructuring costs in that year. We don't see those restructuring costs recurring in 23. We do see the freight business on a really good trajectory towards where we want it to be. We do see the contract logistics business getting much better in terms of the sweating the warehouse assets and a return to post-COVID normality with respect to fuel, and that the addition of Fluidx is a very positive one. So those are the key points and summaries. Again, really appreciate you taking the time and listening. And as we get around the country and the ASM, we'll be providing a proper full guidance of how we see the business shaping up and looking for 2023 and beyond. So on that note, thanks again, folks. And unless we've got any other audios, I'll sign off from there.
This concludes today's call. Thank you for your participation. You may now disconnect.